bottoming, and now is the time to buy. In this video, I'm going to walk you through 5 reasons why I believe this to be. First, we're going to talk about the divergence on the weekly chart. Then we're going to talk about my high 5 setup and how it meets all 5 criteria on the daily chart. Then we're going to talk about how to buy through my valuation metric tool. Then we're going to talk about how this company is a growth beast and they're going to get back to growth, in my opinion, and how they've been beaten down 40% over the year for not valid reason. Lastly, we're going to be talking about how this company is going to have major growth and expansion overseas. So let's get into it. So here we have the weekly chart pulled up. We can see this major support and resistance line dating back to 2021. We had this massive run up. We had this double top, and then we had a fall from grace. Now, there's a couple things we can see here before we get into the indicators. We have a good support line. We have this massive volume shelf on this volume profile with a massive volume gap up to about $48 to $48. And then you have this key resistance point from $48 to about $54 per share, which is about almost a 60% run up from current prices. And again, this is on the weekly chart. So if we go down here, we can see that my thesis for the bottoming out of Celsius is as follows. First, the MACD, we are curling, and we are at one of the lowest points. We're at the lowest point the stock has ever been. And we are curling up and almost making a cross for a bullish divergence on the MACD. Next, we have this bottoming out pattern, and we've made a higher low, purple through yellow, for an uptrend on the RSI after being extremely oversold. Next, we have the stochastic or the trend. And essentially, we are, again, bottoming out here. Red over yellow, bullish indicator, moving upward. Now, this can always turn downward, but we have 3 indicators now, bottoming out and starting its uptrend. Finally, we have the Williams R, where we had a higher low and now another higher low shooting up into the sweet spot. So as we can see, 4 different indicators are showing us that we are in a bottoming out period, making higher lows and uptrending while the stock is going sideways, right at a key support area dating back to 2021. Also, where we have a massive volume shelf. Now let's get into my high 5 setup on the daily chart. So my high 5 setup here consists of having some sort of charting pattern. As you can see here, we have a symmetrical triangle. We have an ascending triangle here. It's our first of the high 5 setup. Then we have a volume gap, which is about a 20% move from where we currently are right now. The ascending triangle, I measured it, and the measured move is 21%, a little over 21% higher to about 43.92, which actually kind of lines up really well with our weekly chart. So we have these 2 as our high 5 setup. Next, we're going to look at our MACD. Our MACD is consistently making higher highs while staying above the orange line, which is bullish. Next, we have, again, higher highs on the RSI, purple crossing, almost crossing through yellow, but continued higher highs from this bottoming out period. Finally, we have the RSI, which is the stochastic, which is also bottoming out. I actually use the same stochastic as the weekly here, so it's the same bottoming out pattern, and we are moving higher. So we have these 5 trading setups. For my high 5 setup that I use in my trading strategy, it has an 80% win rate. This is something that I've built, basically, the strategy over the years, and It's been very successful for me, and I'm very confident in it. So we talked about the weekly divergence that we're seeing. We talked about the high five setup, which tells us we have a positive trade set up right here. Obviously, we haven't broken out of this ascending triangle yet, but I'm with everything I'm seeing, I'm honestly really thinking about starting a position here because the downside, in my opinion, the risk I would be taking is very limited. So I come here, right? I put in my trade, say Monday morning. I have this upside, let's just say to this gap fill, to this volume shelf launch gap fill. So we have about a 20% move. So I would risk a 3-to-1 risk to reward ratio. Just call it 2.98. So I'd be risking a little over 6% for almost 20%. Now, as soon as this thing would fall down and close the day underneath this, I would exit the trade already. So this is where I would put my stop loss. But if I had a confirmation breakdown and then say like an engulfing candle breaking down out of this ascending triangle, I would just already close the position. Just because we are here at this juncture, I believe we're going to bounce and continue to get tighter and tighter on this ascending triangle. So that's how you can also play these patterns, is by launching off the bottom with a volume shelf. And who knows, if you come up here, you take a little profits running into the resistance, but say you break through and then you still got a decent size of your position, or you can add more to your position as soon as you break through, a little bit more to your position when you break through, and then come back for a retest, get a confirmation of the retest upward, and then add even more to your position. So you can play this in a couple different ways. That's most likely what I'm going to be doing, buying some options and some shares. I also have this position in my long-term portfolio, which is the next thing I want to talk to you guys about. So if we come over here to my valuation metric, it takes into consideration discounted free cash flow yield, price to earnings, PEG ratio. We have margin of safety in here that spits out a price based on our terminal value, free cash flow yield, and our expected free cash flow margin rates, with putting in conservative revenue growth rates for this company. And I even put this in here. This is something that I haven't seen anybody else do. We have a current margin of safety, and I've added a current margin of risk. This kind of lets me know when to trim my position in my long-term portfolio and how much to trim it. So say this thing ran to $80 or about $79, and we continuously upgrade this, but let's just say we continuously upgrade this with earnings, and this still says $79, say in 3 months from now, and it's still at 79 and the stock price is at $79, $80. Well, I'm gonna probably trim half my position. That's just how I do these things. Because more than likely with these growth companies, the earnings are going to stick with the price going up, and then these will continue to go higher and higher, and then it'll be more like a 10% trim, 20% trim here and there, and then you can most likely enter back in at 10 to 20% current margin of safety. It's not timing the stock, in my opinion. It's more so just taking the probabilities and lining them all up and figuring out, when to trim your positions. Because I think trimming positions is good. Not fully selling out of your positions and then getting back in, fully selling out, getting back in. I don't believe in that. But let's go through this model real quick on Celsius. So I have a 16% free cash flow rate for the next 5 years. And then for the last 5 years of this 10-year analysis, I have a 22% free cash flow margin rate. And then our terminal value. So basically at the end of the 10 years, this is the free cash flow multiple we'll assign to the company. And I just think with the rate this company is going to grow in the energy space, I think they're going to compete with Monster. they're not going to dethrone Monster, but I think they're going to compete with margin, carve out or with Monster and carve out their own little niche area within the energy space. So I've signed a 20-year multiple at the end of the 10-year. And then we have all our revenue starting numbers, our free cash flow right now. These are all updated numbers right now. So as of right now, we are 4 of 6 on our valuation score. So we have a positive free cash flow over 3%, which is what you want for a great buy. Between 2 and 3% is it's okay. And then below 2% is highly overvalued. But depends on the stock. Some growth companies like a Tesla, I don't look too much into this. I look more so into the free cash flow and where are my buying opportunities in here of my current safe margin of risk and safety. So you also have your PE, about 20, about 30 plus is going to be your, about 25 to 35 is your middle tier. 35 plus is your red tier, you're overvalued. And then 25 or less is going to be your good area, your buy area essentially on this chart and getting your valuation score. I give it the benefit of the doubt with a 28. I just think the growth in this company for the States and overseas is just massive. I think they had a bit of a hiccup with the Pepsi inventory debacle, and I think it's way oversold, and I think they're just going to get back on track. The PEG ratio isn't really lining up. That is red. We want that below 1, and I think that's just because the EPS this year did take a dip due to the inventory with Pepsi and everything. So like I said, this could easily be green, so you could have a 5 of 6 set up, and then as soon as they, as soon as next year they get this EPS back going with their growth rates, you could have a 6 for 6 setup. So I'm good with this 4 for 6 setup and buying this company, and I just keep on dollar cost averaging into it. These are the revenue growth rates I have over the years, and these are actually what analysts are saying. I believe they can get to 20% for the next 5 years or more. Then get back to that 20+% growth that they were having, and then maybe then start to teeter off on the last 5 years of this 10-year model. But that's what I'm kind of seeing. Let me know what you're thinking in the comments. Let me know if you think a fair value is of 53 is right for Celsius, and let me know if you want to see any of these other stocks on my high five setup, or on any other stocks you want to see on my valuation metric tool. I'd be happy to make a video as soon as I get some time. If you made it to the end of the video, I really appreciate you. Follow for more, and have a great rest of your weekend. Thanks.